Got it. And then you're good to go. I'll kick into it.
Yep.
You have the con. Okay, three, two, one. G'day, expats, ladies and gentlemen. Thank you for joining us today on another webinar put on by us, the Atlas Wealth Group. Today, we're looking at financial considerations for Australian expats in the US with a main focus on returning to Australia and retirement planning. A bit of housekeeping as we start to get into the slides and as we have people sort of virtually file in. If you do have any questions, drop them in that question box because Mitchell and myself, we will attend to them at the end. A couple of slides to work through today where we'll be talking about a few important topics, four main topics today. What would a webinar be without some legal disclaimer? And essentially summarizing this slide, it's essentially saying that anything you hear today is general in nature and is for information and entertainment purposes only. It's not to be construed or taken as personal advice. If you do need personal advice, please seek out a tax accountant, a tax lawyer, a financial advisor, or a US financial advisor, perhaps, because today is general in nature. If we head over to the next slide, a bit of a brief on me. I myself, Managing Director and Financial Advisor for APAC region for Atlas Wealth Management. I've been doing this for just over 15 years. I was previously a tax accountant, but I moved away from that because I wanted to be able to do a lot more for my clients. And right now, I mainly focus, as I mentioned before, on the APAC division, I guess you could say, which is Australia, the Pacific, the Asia, and also the Americas. If we head over to the next slide, the other panelist today and co-host is Mitchell Kelsey, one of our other APAC specialists. He's been providing advice for just over 10 years now, has a Bachelor of Commerce with majors in both financial planning and finance. Similar to myself, we like to provide a lot on the tax financial side, the cross-border side, with a specific focus as well on the super and investment planning. If we head over to the next slide, a bit about the Atlas Wealth Group. Well, we are the leading provider in Australian expat financial advice. We provide tax mortgage advice. We provide tax and mortgage services, I should say, as well as asset management services. We're currently regulated by ASIC, the ATO, and the DFSA, and I'm sure those initials will just keep going up over time. We have clients in over 45 countries, and that number just keeps growing. All our specialists are degree qualified and registered within the Australian regulatory body, which is ASIC. If we head over to the next slide, we'll be talking about a few things today. We're going to drill down on US retirement accounts, 401ks, IRAs, Roths, US Social Security, returning to Australia and the tax side of that, some strategy ideas to consider for retirement, and then we'll wind up today with a bit of Q&A. So that'll be what we'll touch on today, and we'll jump into the first topic, and I'll now hand it over to Mitchell to run us through the US retirement accounts.
Thanks for that intro, James, and welcome everyone to today's webinar. With this first section of today's webinar, as you know, this webinar today is for Australian expats that are based in the United States and looking to come back to Australia at some point. And naturally, a big part of being overseas in the United States is whether or not you should opt into a retirement plan in the United States as well. So this first section just aims to provide a bit of a fundamental understanding of the different types of US retirement accounts that you might experience over there, and just some of the tax considerations to be mindful, when you do come back to Australia. So if we just look at some of the basics, so the most common one that most Australian expats in the US will come across is a 401k. And then with 401ks, you've got two different variants. You've got a traditional, and then you've also got a Roth 401k. This is quite rare. I've seen very few of these for a lot of clients and individuals that I've spoken to in the United States. So for the most part, you're looking at these traditional 401ks. And with a 401k, usually it is sponsored by your employer. And then as part of that, you may receive a contribution matching scheme. So with a contribution matching scheme, effectively your employer, you might be lucky enough for your employer to agree to match your contributions to the 401k account up to a certain percentage of your salary. So if your salary was, USD 200,000 and you contributed 10,000 to your 401k in a given year, your employer might match up to 10% of that. So if your salary is 200,000, they're going to match up to 20,000. So they'd match your $10,000 contribution with a $10,000 contribution as well. So it can be quite beneficial in the US. Employee still chooses the investment and bears the investment risk as part of these schemes. And what's quite unique with 401ks is a little bit different to superannuation, where the investment tax is actually tax deferred. So you're not actually paying tax on the investment earnings until such time as you actually make a distribution from the 401k. With that, there is a early penalty tax if you do look to access it before the age of 59 and a half. So this is quite unique if we compare it to superannuation. With super, it's preserved in nature, so you can't access super until usually age 60. But with these 401k accounts, you can actually access it before the age of 59 and a half. But you just need to be mindful of that early penalty tax of 10%. And similarly to super, there are some annual contribution limits to be mindful of as well. We can't look to contribute beyond certain contribution caps. So for the Roth 401k, very similar to the traditional 401k, the key consideration is it's tax paid. So the contributions that are made into the Roth, they've usually been taxed before. However, the earnings and the withdrawals made after retirement are usually tax-free. So that's the key distinction there. Whereas with a traditional, the tax is paid at the time of withdrawal. Still with the same as the 401k early penalty tax of 10% for withdrawals before the age of 59. And again, there's going to be those annual contribution limits that apply. So with the traditional IRAs, so an IRA is effectively a 401k that doesn't have an employer sponsored. So IRA stands for individual retirement account. The earnings accumulate tax deferred and then taxed on withdrawal. Similarly to the 401ks, there's an early penalty tax of 10% before the age of 59 and a half. With the Roth IRAs, these tend to be a little bit more common than the Roth 401ks. A lot of individuals in the United States look to open a Roth IRA. And the benefit of that is, while the contributions, so the money that you contribute has already had tax deducted from it, but because of that, the Roth IRA, the earnings and the withdrawals are not taxed when you look to make a withdrawal after meeting certain eligibility requirements. Again, there is going to be that early penalty tax of 10% for withdrawals before the age of 59 and a half. Now, if we look at the taxation of these types of US retirement accounts, naturally, the tax that is going to apply is really going to be dictated by the individual's tax residency status at that point in time. So most Australian expats, they will usually just hold on to their US retirement accounts until they come back to Australia. And then it's important to note that there will be some tax considerations here in Australia if you are looking to make a withdrawal from your 401k when you're back in Australia. And the tax treatment the way I've broken down this slide is to 3 different scenarios. So you're either an Australian tax resident back here in Australia, you've cut ties with the US, or you're someone who's still in the US and you're there on a temporary resident visa, you're a US citizen or a green card holder. And then the third scenario here is you're a dual resident. So you've got a dual citizen, I should say. So you've got Australian, you're back here in Australia, but you're a US citizen. So in the event you're just an Australian resident, you've cut ties with the US, your US retirement accounts, your 401k, your IRA, how the Australian Taxation Office sees or treats that overseas retirement account. It treats it as a foreign trust under Section 99B of the Income Tax Assessment Act 36. And effectively what that means is the Australian Taxation Office is going to look to include in your Australian assessable income the growth component of your IRA or your 401k account. So the contributions that you've contributed and your employer has contributed, that's not necessarily going to be taxable by the Australian Taxation Office here in Australia. And usually what happens as well, if you're back here in Australia, you've cut ties with the US, you're what's referred to as a non-resident alien, NRA. And where that is the case, the 401k or the IRA provider, whether that be Vanguard, Charles Schwab, they will usually look to withhold a flat rate of withholding tax on that distribution from the US side. It's usually at 30%. However, if you are successful with submitting what's called a W-8 form with the 401k provider, some providers won't look to withhold that 30% withholding tax. It is very much a hit and miss. So usually the 401k or IRA provider doesn't acknowledge that W-8 and they'll still look to withhold the 30%. In which case, you should look to file a tax return in the US, and then you look to receive that withholding tax as a tax refund on the US side. So if you're just a US tax resident, so if you're still in the United States, as I said before, the earnings and then the contributions that you've contributed to that 401k, it's taxable on the way out. So when you look to make a withdrawal, that amount is then included in your ordinary income in the US. If you're a dual Australian US resident, similar situation applies. So same scenario where the earnings and the contributions are going to be included in your ordinary income in the US. So you're not going to have that 30% withholding tax. So that's sort of the distinction there. And if you are here in Australia, the growth component is still going to be assessable. However, you will get a foreign tax credit for the tax that you've paid to the IRS on that distribution. So that's a bit of a high-level summary in terms of the types of US retirement accounts and the general tax treatment that can result by making withdrawals from your 401k. I'll now just hand over to James, who's just going to touch on US Social Security.
There we go. Sorry, guys, I had the mute button pressed. US Social Security. So, I mean, it's a good topic just to jump into today, because a lot of Australians that head abroad that are just on your E3 and L1 visas, they can stay there for quite a long time. They sometimes go down the green card pathway as well. And we just wanted to do a short summary of the eligibility for it. So right there, if we were to look at how you qualify to receive Social Security when you're eventually retired in your 60s, you need to at least get 10 years worth of work or 40 credits. 40 credit is essentially a quarter, 1 quarter, 40 quarters to qualify for retirement benefits from the US. It's based on the tax that you're paying into that Social Security system. So the more tax or the higher income earner that you are, the larger the benefit down the road that you'll actually receive when you start accessing it. So everyone's Social Security benefits are different because it's based on sort of your annual contributions. The amount right there of your benefit is based on your highest 35 years of earnings. So again, it does get based on that amount of tax that you're kicking into the system. You can access it from age 62. The full retirement benefit there is at age 67. If you do delay it until after 67, let's say 70, by delaying it, you do get the benefit of indexation applying on that, especially between the years 62 up to 67. The indexation factor for those years is almost close to 7%. So you're getting a 7% additional benefit each year that you wait. And obviously, that might change in the future, but it is one of those things that the longer you leave it, the greater the benefit. And each year, the benefit does get slightly indexed a little bit in terms of cost of living pressures and just because of CPI as well. It's not much. It's definitely not much to write home about, but it's a little bit. If we move over to the next slide, how is Social Security treated by the ATO? So a really good one. And if we can see there, I guess summarizing the slides, it's taxable in the eyes of the IRS on the US side, which is normal. So typically with a lot of our clients that are receiving Social Security, they have generally a flat rate of tax withheld. And usually it'll range between 7% up to 22%. And that's normal. That's completely fine. You can actually lodge a form to change the withholding rate as well, depending on your other income sources within the United States. When you're receiving Social Security, and if you're an ordinary Australian tax resident at the time of receiving it, it's actually tax exempt here on the Australian side. It's probably the one good thing that's come out of our double taxation agreement between the US and Australia. But yes, under Section 6.5 of the Income Tax Act, it is not assessable. So it just means that it will provide a terrific income supplement, even though it's taxed a little bit on the US side, but not taxed at all on the Australian side. So when I look at my clients right now, they're getting a terrific monthly income supplement because the US currency is quite strong relative to the Australian dollar. It's helping them stretch out what they can actually spend each month, which is great. And it might mean that they're not having to draw down on their other assets as much. If we head over to the next slide, I'll now hand it back to Mitchell to run through the next topic.
Thanks, James. So this next topic, I mean, returning to Australia and tax, actually, it's quite broad. So the aim of these next couple of slides is just to touch on some key considerations for Australian expats when they are coming back and the tax implications that they need to be mindful of. The first one, and this sort of ties in nicely with the first topic that I was talking about, the US retirement accounts. So as I said, if you're an Australian resident, you've since returned to Australia, the distribution or withdrawals from a US retirement account, there is going to be a component that is accessible with the Australian Taxation Office. And as I said, the Australian Taxation Office will treat your US retirement account under Section 99B. So it sees it as a foreign trust. And with this legislation here, it's actually quite, I won't say cheeky, but there's some like layers here that Australian expats that are coming back to Australia need to be mindful of, whereby if you are making a withdrawal when you're still a US resident for tax purposes, so you may still be in the United States and have taken a withdrawal from your 401k and then return to Australia 6 months later. If that withdrawal and the time and then the time at which you return to Australia all takes place within the same income year, that withdrawal can still be included as assessable income in the Australian tax year. So it's still going to be assessable income, even though you made that withdrawal whilst you're still in the United States. So that's sort of really sort of finer detail to be mindful of with this provision of Section 99B. And then also, I mean, staying on, harping on a lot about Section 99B, but it is important. And with the Section 99B tax treatment, it doesn't distinguish between whether or not your US retirement account is a traditional IRA or if it's a Roth IRA. So while the withdrawal might be tax-free on the US side, which is the case for Roth IRAs, it's not going to be the case here in Australia. So you're still going to have to incorporate that growth component into your Australian tax return. So those are two key considerations to be mindful of when it comes to US retirement accounts and you're since back in Australia. The big one for Australian expats is this US exit tax. And the exit tax is incorporated as part of this HEART Act, which is the Heroes Earnings Assistance and Relief Tax of 2008. Obviously, this tax, this act here covers a whole range of other provisions outside of just this exit tax provision. But essentially what it is it can result in a capital gains tax event on an Australian expat's worldwide assets. And the two types of individuals, well, the two types of scenarios where this exit tax can apply is when a US citizen renounces their US citizenship, or if a green card holder, and that green card holder has had that green card for 8 of the last 15 years, decides to return their green card. So those are the two scenarios where this HEART Act can apply. And so if you fall into one of those two categories, then essentially there's part two. So you will be treated as a covered expatriate. And then it's simply just a case of working through these 3 tests. So you need only meet one for this HEART Act to apply. So we look at the income tax test first. Effectively, this is just looking at what your average income tax liability has been in the United States over the last 5 years. And if it's greater than US 190,000, you will be subject to this HEART Act. And 190,000. So you're looking at an average. So if your income tax liability was around 190,000 or more than 190,000, it does mean you would have had to have earned, 500, 600,000 per annum on average over the last 5 years. So it's not your income, it's your income tax liability. There's also this assets test where effectively if your net worth was less than US 2 million as of the date of expatriation, it's not going to apply. But if it's over 2 million, it's going to be a case where it will apply. And then lastly is the certification test. And I guess this test is the one that I guess creates a bit of concern for Australian expats because it's just looking at your tax compliance. So, individuals are thinking, oh God, was I compliant with all my tax returns, my, information returns, FBARs, these types of forms over the last 5 years. So if you can show good compliance with your tax reporting over the last 5 years, then it's not going to apply naturally. So those are the three tests. And if it's a case where you do meet one of the three tests, I'll just work through some of the impacts. And it sounds kind of, confronting, there's this exit tax event happening on your worldwide assets, but it may not, the impact when we work through some of the exemptions it may not be so detrimental. So like I said, it's a deemed sale whereby you realize the gain or loss on your worldwide assets. So the IRS is effectively wanting to know what your worldwide assets are. They're going to probably know that already anyway. So they're looking at things like your real estate assets, your superannuation, your retirement accounts in the US, and effectively determine what the capital gain on those worldwide assets were. Quite a detailed calculation that tax accountants have to work through. And then essentially, it's important to note that there is an exemption for the first 744,000 US of capital gain. And there are special rules that will depend on the type of asset. So obviously with cash, you're not going to have such a significant capital gain on that as an asset type. You've also got real estate. So that's probably the key consideration where if you've got, worldwide real estate assets that appreciated in value quite a bit, that's likely where a lot of the capital gains are going to arise. And then lastly, if we look at some of the other provisions, and there's this one in particular that relates to deferred compensation. So if we think about deferred compensation, looking at things like equity-based compensation, such as stock options or restricted stock units, whereby you're being granted these this equity in the firm, but it hasn't vested to you just yet. So it's not actually available to you at this point. However, at the time, should this Hart Act apply, the RSUs that you do have, they can, even if they are unvested, they are treated as being substantially vested to you at that point, and the value of those RSUs are includable in assessable income. So quite a significant consideration there, for anyone that is thinking about renouncing US citizenship or has that green card, who is a long-term tax resident in the United States on those green card visas. So just be super mindful of that, and speaking to a really good US tax accountant before making a decision on those visas is crucial. I'll now hand back over to James. James is just going to run through just a couple of strategy ideas for retirement.
Yep. Thanks, Mitch. Yeah, I mean, today we just wanted to give some insights, things to be mindful of when you are looking at planning for your retirement, because we do find a lot of, I suppose, clients, expats that come on board, they have sort of started just with the wrong foot in the wrong direction. So if we turn over to the next slide and look at some general strategy ideas for retirement, probably the biggest one that we see that impacts our clients, and I guess Australian expats as a whole, is trying to manage that foreign currency risk, because you're earning obviously your salary, you're growing some assets in the US in a completely different foreign currency to where you're likely to retire based on our clients. And therefore there is a lot of risk that you leave yourself open to. If you do have intentions of returning to Australia, then I would say that means that the biggest risk you have is, not accumulating your wealth back in the Australian dollar. Right now, when we're talking to, I suppose, a lot of expats that are looking to return very soon in the next 1 to 2 years, a lot of them have been essentially following this last minute transfer, or I suppose avoiding and I guess they have been following the end of period approach, I should say. So that just means that they've accumulated their wealth all in US dollars, and now their plan is to move it all back to Australia. That's incorrect. Really, you should be taking a more of a dollar cost averaging approach and transferring your wealth back to Australia on, say, a monthly or quarterly basis through, say, your surplus, building up your asset base here. And that's help, obviously, taking a bit more of a weighted average approach to the cost of currency, and therefore you're addressing that currency risk over the entire period that you've been in the US rather than just at the end. When we look at the fluctuations in the US dollar to the Australian dollar over the last 30 years, there have been times where it's been on parity, a dollar for dollar. There's been other times where the Australian dollar has been worth a lot more than the US dollar, $1.10. So that means that if that plays out, when you come back, you've lost a significant amount of wealth. And the easiest way that you could have addressed it is sending back portions of your wealth, your savings throughout that life or that period back to the Australia dollar in Australia and putting it into some assets here, whether it's direct shares, a bit of superannuation, paying down debt, buying property. There's a lot of different avenues that you can look at. Now, if we head over to the next slide and we look at Australian superannuation, we just want to talk about and give a quick high-level summary. So first and foremost, when we look at, I suppose, US citizens retiring in Australia, contributions to super funds can generally be accessible by the IRS. And sometimes if we've contributed too much, we could risk the super fund being treated as a foreign grant or trust. We can still draw down from the super in retirement. Absolutely. We can technically access it from age 60. However, generally that income stream is just going to be treated as some sort of foreign income in the eyes of the IRS. When you look at the two systems that you can lean on, there's the foreign earned income exclusion and the foreign tax credit system. Generally speaking, you can't include I suppose, the pension income from an Australian super fund under the foreign earned income exclusion because it's technically passive in nature. So there's not, and because of the foreign tax credit system, and how that operates in Australia, we're very lucky. The account-based pension is tax-free. We don't have to declare it to the ATO. So unfortunately, there is no tax credit to use in that instance. When we look at drawing down a combination of super and US in retirement, it does mean you'll be using assets such as your IRAs, your 401ks, and a little bit from super as well. If we look at the next type, Australian citizens that have been maybe on a temporary visa, such as an E3 visa, maybe an L1 visa, or you've been a US citizen that's renounced their US citizenship and given back their green card, well, that's great. Super becomes sort of one of your best retirement assets. And the reason for that is that it is concessionally taxed up until you retire. The maximum tax rate is only 15%. Long-term capital gains are only 10%. And then once you retire, all the investment income, the capital growth, that's tax-free. The income withdrawals are also tax-free. Age 60, that's what we refer to as our preservation age. That's when you can start to access it. Age 65, that's technically our retirement age as well. If we head on over to the next slide and we look at some other, I suppose, areas to be mindful of, and we consider tax effective investments. So when you head over to the US, you need to be mindful of what's called a PFIC, a passive foreign investment company. You can Google to your heart's content and you'll find a lot of information on it, but it is really punitive for any expat that's heading over into the United States. When we look at the legislation piece, so section 1297 of the IRC, a PFIC is any foreign company or trust that meets one of the following tests: 75% or more of its gross income is passive, or 50% or more of its assets produce passive income. So immediately in Australia, that's things like Australian exchange traded funds or index funds, Australian managed funds, it's listed investment companies, it's Australian real estate investment trusts. The list it goes on, but they are your kryptonite when you head across to the US. The reason why they are kryptonite is because as a taxpayer in the US, you'll include the unrealized growth or appreciation as ordinary income in your tax return. If there is any depreciation and the portfolio's gone backwards, you actually can't use that to offset any other income. And then you also have additional US reporting on Form 8621 for each PFIC you hold, and that can be up to $300 per PFIC. A good example would be a client that came on only recently. They had a managed fund portfolio of 15 different managed funds, local Australian managed funds. So they've had to do a very big cleanup, and they're using our Pan Pacific portfolio now. And they just had an absolute nightmare of doing their taxes each year because of the form requirements, the additional taxes. So best thing you can do is just removing your, I suppose, accidental exposure to them. There's a good little handy table there where you can see what we can invest in as a normal Australian tax resident. We can do direct shares, we can do managed funds, ETFs, US listed ETFs. However, US tax residents only direct shares and only US listed ETFs. If we head on over to the next slide, we are now going to open it up for a bit of Q&A. I'll hand it back to Mitchell as he has the con.
Thanks, James. And great summary on those PFICs. That's probably the most prominent sort of issues that we see with our clients in the US. And yeah, it's just good to be mindful of them. As we've been sort of working through this webinar, we've had some good questions coming through. So I'll just work through a couple of them now. So this question come through. I'm heading to the US with my employer at the moment. Should I opt into my employer's 401k matching scheme? I think since I've been covering a lot of the IRA 401k stuff today, I'll look to cover off on that one. So certainly the matching schemes can be quite beneficial for Australian expats. If you think about it in simple terms, if you're making a contribution and your employer is then looking to match your contribution, that is effectively additional salary or additional income to some extent. So hard to pass that up. So that's why these matching schemes, when they are available, they can be quite beneficial. And then if we circle back to when I was discussing a lot of the tax treatment. So when we look at the tax treatment on the Australian side, the ATO isn't so concerned with taxing the contributions that you've made to the 401k over time. They're only concerned with the growth off the back of those contributions. So can be quite beneficial to opt into those schemes. The only other consideration would be what would you otherwise do with those funds. But for the most part, it can be quite beneficial to opt in with those if you're getting a match from your employer. Another question here on our 401ks, what is better, traditional or Roth? Did you want to jump in on that one, James?
Yeah, absolutely. Yep. Really good question. When you look at sort of your traditional versus a Roth, I think personally, I think a Roth is very suitable for someone that probably has the intention of retiring in the United States. And when Mitch was talking about it previously, the ATO doesn't really distinguish the difference between sort of a traditional IRA account versus a Roth. A Roth is made up of after-tax contributions. You've got your annual limits, and then when you reach the relevant sort of access age, normally 59 and a half, you can pull it out and it's tax-free in the eyes of the IRS, whereas a traditional IRA is just taxed at ordinary income rates. So if you then zoom out a bit more and then go, okay, well, I'm going to be accessing that account when I'm in Australia, retired. Well, the ATO doesn't really provide any relief on a Roth account. It treats it the exact same way, your standard 401k or a traditional IRA. So theoretically, that would mean you are double taxed by the IRS and the ATO on your Roth account. And that means that it's not really a tax efficient investment or retirement vehicle if you know that you're going to be coming back to Australia and retiring. If it's a case that you can time the withdrawal to withdraw in full before you return to Australia, and you're pulling it out and you're returning in a completely different financial year in Australia, that's a really good outcome. But often Mitchell and I don't really see that happen and play out with our clients. So I don't traditionally advocate any clients using a Roth because of how they're double taxed and can pay up towards sort of 50% tax technically on the Roth withdrawals because they're taxed on the way in because it's after tax contributions, and then it's taxed on the way out by the ATO. So if you have an option, traditional IRA will give you more tax benefits whilst you're in the US, and then you're just going to be paying, your standard little tax amounts and getting a tax credit here in Australia for any taxes withdrawn by the IRS when you start looking to distribute it. That's probably the best way to do it. It's sort of a case when I think Mitchell would agree that it's case by case, but I don't openly advocate for a Roth type of retirement account.
Yeah, good summary there, James. I wouldn't add anything else to that. There's a couple of questions here on US Social Security as well. So it says here, you talk about Social Security being tax-free here in Australia. What are the general minimum requirements to get it? So we worked through a couple of the eligibility requirements, and the main one is those 40 quarters. So usually need to have paid taxes for the last 10 years in the US. There's some unique rules around spouses being able to access US Social Security as well. So if you are a spouse of a US citizen or someone who worked in the US for the last 10 years, that there may be some opportunities there for you to also claim a spousal sort of Social Security benefit as well. Another one here on Social Security. Do you need to be a US citizen to claim Social Security? Do you want to jump on that one, James?
Yeah, sure. So that's a really good question because I think there's always often a lot of confusion around who can actually access Social Security. And the quick answer, no, you do not need to be a US citizen to access Social Security. You could have been in the US on, say, an E3 visa, probably the most common type of visa with Australians. You could have been in the US on an E3 visa for, say, 15 years, doing your annual review, your review every 3 years on the visa. Because you've still got the minimum 10-year requirement or 40 quarters, you are 100% eligible to receive Social Security benefits when you're in your 60s. So you do not need to be a US citizen. You just need to have those minimum, I suppose, contribution requirements, and then you can access it from age 62. Back to you, Mitch.
Yeah, great summary, James. The last question we've got here today was on transferring money back to Australia. So I'll address that one. What's the best method to transfer money back? So we talked about a couple of ways you can strategize transferring your funds back to Australia, including dollar cost averaging. So instead of just waiting until the last month of being in the US before you come back and transferring all the funds back at that point, give yourself plenty of time. So, in the last, 12 to 18 months of coming back, have a bit of a strategy in place where each month or each quarter you look to send back some funds on a regular basis, and just be disciplined with that approach. As we know, the foreign currency fluctuates from day to day. So, some months you're going to get a good rate, other months not so good, but on average, you're going to get a good average conversion rate over a period of time, such as 12 to 18 months. And then how best to do it. There's some really great foreign exchange platforms out there in the market now, rather than going through some of your major banks. Usually these FX platforms give you a much more competitive foreign exchange rate because they do it on more of a wholesale level, and that is their sole business model. They're just looking to make FX conversions for their customers. I might wrap it up there, James. Appreciate you joining me on the webinar today, and also for everyone for joining in. If you do have any questions on the slides or what we've discussed today, please feel free to reach out through our website, through the contact us. Otherwise,